Starting over with limited capital forces clarity about what truly matters. Noise fades when resources are finite and decisions carry weight. The focus shifts from clever tactics to durable principles. With $25,000, survival, patience, and discipline matter more than speed. Warren Buffett's thinking emphasizes simplicity when outcomes feel uncertain. Not because simplicity is easy, but because it endures pressure. Starting over means rejecting shortcuts and embracing foundations. The goal becomes staying in the game long enough for compounding to matter. The first priority would be protecting capital, not chasing growth. Losses hurt more when capital is small and recovery time is limited. Avoiding permanent mistakes matters more than maximizing early returns. Capital protection creates options when conditions change. Clarity begins by defining what you will not do. Avoid leverage that magnifies errors and volatility. Avoid complexity that hides risk behind sophistication. Constraints create discipline and reduce emotional decision-making. Cash flow awareness would guide every move from the start. Understanding where money comes from and where it leaks builds control. Control reduces anxiety and impulsive choices. Calm decisions compound better than reactive ones. Time becomes the most valuable asset when starting over. Time allows learning, adjustment, and recovery from mistakes. Rushing compresses learning and magnifies errors. Patience stretches limited capital further. Quality matters more than diversification at small scale. Owning too many things dilutes understanding and accountability. Fewer positions encourage deeper thinking and responsibility. Concentration demands care, not confidence. Circle of competence thinking narrows choices intentionally. Fewer choices reduce the chance of costly misunderstanding. Familiar businesses are easier to evaluate under stress. Understanding lowers fear during inevitable volatility. The early phase would favor boring consistency over excitement. Routine actions build momentum without emotional spikes. Boring systems survive distractions and market noise. Stability supports better judgment. Starting over requires humility more than brilliance. Mistakes will happen, but arrogance makes them fatal. Humility keeps learning active and risk contained. Progress begins when ego steps aside. Starting small sharpens attention to costs that quietly erode progress. Fees, taxes, and unnecessary turnover matter more at modest scale. Small leaks feel invisible at first. Over time, they compound against you. The early mindset favors learning before earning aggressively. Understanding businesses deeply takes time and repetition. Reading, observing, and comparing build judgment slowly. Judgment reduces reliance on forecasts. Income stability supports patient decision-making when capital is limited. Predictable cash flow reduces the urge to force outcomes. Stability creates space to wait. Waiting improves timing. Simple screening beats complex models at the beginning. Clear criteria eliminate distractions and false precision. Simplicity reveals weaknesses faster. Faster feedback improves learning. Risk is best managed by avoidance early on. Avoid situations where outcomes depend on luck or leverage. Avoid stories that promise speed. Slow progress preserves capital. Reinvestment discipline matters more than initial selection. Letting gains compound quietly requires restraint. Frequent changes interrupt compounding. Consistency turns modest wins meaningful. Patience is tested most when nothing happens. Quiet periods feel unproductive and tempting. Stillness is part of the process. Doing less is discipline. Mistakes should be small and survivable. Learning accelerates when errors teach without destroying progress. Survivability keeps confidence intact. Confidence supports clarity. Comparisons distort judgment at every stage. Others' results are rarely comparable. Comparison invites impatience. Impatience increases errors. Starting over rewards focus on process, not outcomes. Outcomes fluctuate beyond control. Process remains controllable. Controllable actions build resilience. The search for opportunity begins with businesses, not markets. Markets change moods quickly. Businesses reveal patterns over time. Familiarity reduces fear. Durability matters more than excitement. Durable businesses survive cycles and mistakes. Excitement fades. Quiet compounding endures. Pricing discipline matters more than perfection. Overpaying erodes returns. Reasonable prices allow margin for error. Margin protects mindset. Learning to wait becomes daily practice. Opportunities do not arrive on schedule. Waiting tests temperament. Temperament determines outcomes. Understanding incentives guides evaluation. Management behavior reveals priorities. Aligned incentives reduce surprises. Misalignment increases risk. Avoiding frequent trading preserves focus. Activity adds cost. Fewer decisions mean fewer mistakes. Stillness allows insight. Early wins require caution. Success creates overconfidence. Overconfidence invites risk. Staying grounded protects progress. Losses are studied calmly. Emotion clouds judgment. Review turns loss into tuition. Tuition improves decisions. Documentation supports discipline. Writing clarifies thinking. Records reveal patterns. Patterns guide improvement. Long-term thinking shapes decisions. Short-term noise fades. Years matter more than months. Patience improves consistency. Temperament matters with limited capital. Emotional reactions amplify mistakes. Calm preserves flexibility. Flexibility allows recovery. Business simplicity is preferred. Simple models are easier to monitor. Understanding reduces surprises. Fewer surprises protect confidence. Reinvesting earnings takes priority. Compounding requires restraint. Chasing novelty interrupts growth. Consistency wins. Risk is permanent loss, not volatility. Price movement is not danger. Irreversible mistakes are. Avoiding them preserves opportunity. Saying no strengthens discipline. Most opportunities distract. Saying no protects focus. Focus improves decisions. Learning from others' mistakes shortens learning curves. History teaches cheaply. Cheap lessons save capital. Studying failure prevents repetition. Patience during excitement protects capital. Excitement tempts action. Resisting temptation preserves resources. Resources enable future participation. Progress is measured by behavior. Process matters more than results. Good process produces outcomes. Process stability reduces anxiety. Humility grounds the journey. Markets humble everyone. Humility keeps learning active. Learning sustains progress. Confidence grows from repetition. Sound decisions reduce doubt. Process-based confidence resists moods. Mood resistance prevents errors. Cash-generating businesses support resilience. Cash flow reduces reliance on markets. Independence improves patience. Patience improves timing. Balance sheets reveal strength. Strong balance sheets provide room. Weak ones magnify mistakes. Strength matters. Reading compounds knowledge. Knowledge compounds quietly. Quiet learning sharpens judgment. Judgment improves decisions. Avoiding stories protects reason. Stories persuade emotion. Facts anchor reality. Reality survives volatility. Incremental improvement replaces drama. Small refinements compound. Consistency beats intensity. Discipline lasts. Holding matters more than buying. Holding tests temperament. Early selling interrupts compounding. Compounding rewards patience. Mistakes are feedback. Feedback refines judgment. Discouragement leads to risk. Learning steadies progress. Clarity filters opportunity. If unclear, avoid. Clarity reduces misunderstanding. Reduced misunderstanding lowers risk. Long-term vision remains simple. Preserve capital. Learn continuously. Act patiently. Emotional control is a skill. Skills improve with practice. Recognizing triggers reduces influence. Reduced influence preserves rationality. Patience grows with experience. Opportunities arrive inconveniently. Waiting requires confidence. Confidence prevents forcing outcomes. Avoiding debt preserves flexibility. Debt magnifies errors. Flexibility disappears with obligations. Freedom to wait matters. Understanding cycles shapes expectations. Cycles repeat unpredictably. Preparation beats prediction. Preparedness reduces fear. Simplicity guides structure. Too many holdings dilute focus. Focus encourages responsibility. Responsibility improves quality. Monitoring businesses beats watching prices. Prices invite emotion. Progress matters more. Progress compounds quietly. Reviewing assumptions strengthens discipline. Drift introduces risk. Review restores alignment. Alignment preserves intent. Comfort with inactivity is essential. Action feels productive. Inactivity protects capital. Protection preserves opportunity. Capital allocation changes slowly. Sudden changes increase error. Gradual adjustment reflects confidence. Confidence grows with repetition. Perspective counters noise. Noise demands reaction. Perspective encourages restraint. Restraint protects outcomes. Discipline comes from routine. Motivation fluctuates. Routine continues. Continuity protects quality. Opportunity cost. Awareness sharpens focus. Every choice excludes others. Awareness reduces regret. Reduced regret improves confidence. Volatility tests temperament. Calm preserves flexibility. Flexibility improves choices. Better choices follow stability. History provides context. Patterns reduce surprise. Reduced surprise lowers emotion. Lower emotion improves judgment. Crowd behavior amplifies emotion. Process anchors decisions. Anchors prevent drifting. Stability supports outcomes. Quiet confidence resists pressure. Public pressure distorts judgment. Private judgment matters. Judgment shapes results. Conservative risk assumptions protect capital. Room for error matters. Error tolerance preserves survival. Survival sustains opportunity. Automatic reinvestment removes timing. Removing timing reduces error. Simplicity strengthens compounding. Compounding rewards discipline. Ignoring commentary protects focus. Commentary reacts to price. Focus stays on value. Value endures. Process remains unchanged as capital grows. Growth tempts complexity. Complexity reintroduces risk. Simplicity preserves clarity. Temperament outweighs intelligence. Intelligence without control risks loss. Temperament protects decisions. Protection allows compounding. Reflection guides adjustment. Alignment restores confidence. Misalignment signals risk. Awareness prevents drift. Consistency beats excitement. Excitement hides fragility. Consistency builds resilience. Resilience sustains endurance. Avoiding regret guides decisions. Rushed choices cause regret. Slowing reduces regret. Fewer regrets strengthen confidence. Preparation replaces prediction. Predictions fail. Preparation adapts. Adaptation preserves opportunity. Waiting remains valuable. Waiting reduces errors. Fewer errors compound positively. Compounding rewards restraint. Simplicity scales. Complexity grows fragile. Stability supports longevity. Longevity supports success. Growth is a byproduct. Chasing growth distorts behavior. Correct behavior produces growth. Durable growth lasts. Patience with oneself matters. Learning takes time. Time rewards discipline. Discipline creates outcomes. Starting again with $25,000 changes nothing essential. Protect capital. Stay patient. Keep learning. Quiet. Progress outlasts noise. Time favors the discipline.